Hello friends, this is Sanjeev Kaushik and welcome to my channel Methodical Trades. In this video, we'll learn about 4 ways of identifying fake breakouts and how exactly can we avoid from taking trades on fake breakouts. So without any further ado, let's get started. You see, the chances of a fake breakout are highest when we are trying to take the trade against the trend, right? So every time we would try to go against the primary trend of the stock, chances are we can end up with taking trade on a fake breakout. But how do you spot it? In Jan 2022, the US markets had converted into a bearish trend, right? So the primary trend had converted into bearish trend. So what we saw is this is a QQQ ETF, the Nasdaq 100 ETF, and the trend at that time was completely bearish. Although we are seeing some counter trend rallies, right? If you're following my cursor, you would know what I'm talking about. And these are called the secondary trend, right? Which will last for just a few days, but by and large, the primary trend is downwards. Now, when we see these kind of moves, it becomes hard for us to take a counter position. So in order to do that, what we should do is we should put on an indicator called rate of change, and we'll change its setting from 9 to 10. So in trading view, the default is 9, we will change it to 10. And with the help of this, we will try to look for divergence on the chart, right? So as you can see, the bottom formed here has this low on rate of change, but the bottom formed over here, which is a lower bottom, has the corresponding low on ROC at a much higher level. It gives us a tiny bit of confidence that if there came a reversal in this particular counter, the chances are it will sustain. So if you're someone who trades on divergence, then what you can do in such scenario is draw a trend line like this. Let me change the color, right? So draw a trend line like this, and then you can take the position. It enhances our chances of taking a trade that will not turn out to be a fake breakout. The other thing that you have to notice within this concept of rate of change and also taking the counter position against the primary trend is that these kind of secondary moves, what I mean by secondary moves is these upside moves in stock that we see, whereas the primary trend is still downwards, right? So the primary trend is still downwards. These kind of secondary moves are usually very sensitive to oversold or overbought conditions, as can be observed on an oscillator kind of an indicator such as RSI. You can also use MACD for this, but let me give you an example using the RSI indicator. So again, in order to align the inputs on RSI along with ROC indicator, we'll change the RSI length or the number of candles here the number of candles here from 14 to 10, right? And let me make the line a little broader. So what happens is the RSI goes very quickly in overbought conditions if the primary trend is bearish, or if the primary trend is bullish, and if a stock starts breaking down, then it very quickly goes into oversold position. So the RSI becomes very sensitive to counter trend moves. Here you will see that, and let me change the color of this arrow. You will see that QQQ went from 320 level to 370 level. That's a move of 50 points, and RSI already started touching the 70 level, which many people assume to be the overbought region. But from there, if you look at this particular arrow, the QQQ dropped from 372 all the way down to 288. So almost twice the move And after falling 2 times from this counter trend, then we saw the oversold position on QQQ. So what it implies is that RSI becomes very sensitive to counter trend moves. Let me show you another example on QQQs. And by the way, this is a daily chart that we are looking at. So we saw a similar kind of pattern forming up over here, right? We're seeing a constant down move, right? And from there, the ROC was also showing divergence, right? We can compare the bottoms and you will be able to see the divergence. In fact, these two bottoms are more relevant for comparison. And if you were to take a long position here, there really isn't much of a chance, because you see these candles are not really giving us confidence. You see this is a red candle, then these two are inverted hammers, right? So if anyone would have gone long, they would have to be very, very nimble. Otherwise, chances are the position will go into profit, and then after some time, it will come back in losses or at break even, where you will have to exit. So the ROC was definitely showing divergence, but you would see that not much of a follow through, right? So what it means is that the indicators become very quickly overbought or oversold when the trend is opposite to the primary trend. And when this sensitivity is very high, then what we usually see is that the moves are not very high, right? And that's where we will have to be very, very careful. For example, right now, the QQQs are nearing a certain resistance level, and we can see that they are already knocking at the overbought region on RSI indicator, right? So this is the very first point. We see the divergence. Divergence helps us identify whether a breakout can sustain or not. If there is no divergence, there's no point trading. And secondly, we look at the oversold and overbought conditions on RSI to ensure that we're not taking a trade that is already overbought on the long side or that is already oversold on the short side. In other words, at these kind of overbought conditions on RSI, even if we were to get a breakout at these levels, the chances for this breakout to sustain would be very low. It doesn't mean that it would never ever sustain. It can. Anything is possible, because if we again go into a primary bullish move from here, then chances are you would see the RSI dropping down with very minor down move in QQQs, and then from there onwards it would start its journey once again on the upside. So the sensitivity would reverse in this scenario. We're not talking about certainties here. We're only talking about the probabilities of a trade working in our favor, right? So that's one way of identifying a fake breakout. The second way of identifying a fake breakout is by following the 2 candle rule. And let me show you the example of Tesla to exhibit this. You would have noticed that I took an example of Tesla, and I mentioned that above this level is when I will consider taking my long position on Tesla. And if you're interested in that video, I'll make sure that the link to that video will flash right now on the top left corner of the screen. Go ahead and watch it. What you will see here is that I had mentioned that a close above 123, 124 level will make us bullish on Tesla, right? Because I also spoke about divergence. I also spoke about this potential double bottom forming here on the daily chart. And eventually we did get a breakout and Tesla did go up. I believe it is probably already overbought. I don't know. There are also earnings around the corner. So what's going to happen, nobody knows. But as far as the prophecy goes, it has turned out to be right. Anyone who would have entered at 124 levels should have booked profits around 145 or so. Nonetheless, this is a rule, that is, this 2 candle rule is something that professionals who usually share their trade in public forums, say on TV channels, follow a lot. And what they do is they wait for 2 candles to make sure that the breakout is confirmed. So if first candle has closed above the breakout level and the second candle also closes above the breakout level, that's when they share their trading recommendation on that particular counter. I personally am not a great fan of it, but again, I don't have to prove that all my trades work, because at the end of the day, I only trade for myself. So I don't care. I don't really follow the 2 candle rule. But this is something that can be recommended for a beginner, because with two candle rule, the chances of entering into a fake breakout actually reduce. But the flip side of it is that you will end up entering into the trade at a much higher level in some cases, although this is not the case in case of Tesla, but in some cases it can happen. And secondly, you may never be able to take a certain trade because after the breakout, the stock may move very rapidly on the higher side if it's a long trade, or on the lower side if it's a short trade. So there's always a bit of a trade-off. If you want to be safe and secure in your trades, then of course you will have to let go of certain trades, which were the real breakouts, but we just wanted confirmation, so we ended up waiting for the next candle, and the risk reward never really stacked up, and that's why we never took that particular trade. So this is a bit of an issue when you have to wait for two candles. Now, how do you follow this rule? You see this green candle over here. This was the first time we saw the actual breakout happening, but anyone taking long position here is not really running a very high reward to risk ratio. So if they were to wait out the next day, the chances are they can enter at a lower price, right? The candle is huge, a red candle, right? So there's going to be a little bit of a challenge here. That is, you won't be really sure that this trade is going to work out or not, but nonetheless, your reward to risk is now much better as compared to the previous candle, right? And this is also relevant to the third point that helps us identify whether a breakout is real breakout or not, and that is look at the candle action. With this kind of a bearish engulfing candle and the next candle forming doji, you can always have a little bit of uncertainty about the direction of that particular trade. But if you see all the candles in green color, that means it's a confirmed breakout on the upside. So looking at the candle action is our third way of identifying a particular fake breakout. If you see a lot of selling after a candle forms, it opens at a high level, and then if you see a lot of selling, either you see an engulfing, a bearish engulfing candle forming, or if you see an inverted hammer falling, then that is a good indication that that can turn out to be a fake breakout, right? So here, if you would have waited for two candles, you could have taken position here. If you waited for a third candle, you could have taken a position around this doji, and then it worked out. The idea is that while the action of the candles are not really very intuitive in terms of whether the Tesla stock will go up or not, but our reward to risk has started matching here, right? It's very convenient to take a trade near the breakout level, then take it at this level at the very first candle, right? So if you will wait for 1, 2, 3 candles, usually waiting more than 2 candles is really being too much risk averse. So if you're happy to wait for these many candles, the chances are you will not see yourself sucked into a fake breakout trade. Let me give you another example. So what you're looking at here is the chart of ICICI Bank, and this is the COVID-led down move, which happened across the board. So here, the markets, after we had seen a bottom here, and at that time nobody would have known that this is the bottom, we saw that there is still some kind of nervousness in the market. So if you look closely, there would be a trading opportunity somewhere at this level. How? Because there is this double bottom forming here, right? And if you consider the action of these two candles, they don't give you much of a confidence. You will see that this green candle over here has huge wicks on both the sides, right? Even though it's a green candle, but it has huge wicks. That showcases uncertainty. And the next red flag is the red candle, which is a bearish engulfing candle forming right next to it. So if anyone would have gone long looking at this double bottom on ICICI Bank, should be very, very careful. Why? Because it's a counter trend trade, and we are seeing the candle related action not giving us much of a confidence, right? So if you look at these kind of candles, now this is another example, right? If you see, the wick on the upside is huge, right? Which means that the markets are not really very bullish on this particular counter. So what happens is, with these kind of fake breakouts, we do not really get the kind of reward risk that we're looking for. So it's very important to look at certain indicators and also the day-to-day action on the chart. If you're trading on a 15-minute chart or a 30-minute chart, this kind of a candle action is still very helpful in noticing, and that's where you start becoming a professional, where you can add a little bit of discretion on the kind of action that you're looking at. And you can take a call whether you still want to stick in the trade or not. One candle may be a misnomer, but if this is happening on the second candle as well, on the third candle as well, then there is something wrong with that particular trade. So these kind of candles are usually called the poking candles, which would poke out of the pattern and then the counter will go back again. And this happens a lot of time, right? So if you will go back and check your own trades based on pattern or any other system that you use, you will find that these kind of poking candles would have stuck to you in a trade, and then after next candle or the next to next candle, you will see the stop loss hitting right away. So avoid these kind of poking candles as well, and they will help you a lot in making sure that you do not get sucked into fake breakouts. Now, this is another example of what a fake breakdown looks like. You see, there was a continuous downtrend, and here we saw a breakdown of flag pattern, right? Call it inverted flag or flag, whatever. With this red candle over here, we saw a breakdown. But the very next day, we see that the price did not really follow through. And instead, you see the low of these two candles were exactly or almost same, right? So a clear breakdown with huge red candle, but there's no follow through. So it should act as a red flag for us to make sure that we take appropriate action, thinking that there are very good chances that this trade can turn out to be a fake trade or a fake breakdown opportunity, right? And you see what happened next day, a gap up, and the stock is still sustaining as we speak. The markets are open. This is TVS Motor Stock and this is daily chart, right? So this is about looking at the candle action and avoiding the poking candles. And how do you avoid that? Usually look at the kind of candles that are forming, or you follow the 2 or 3 candle rule. Now, the last way of identifying a fake breakout or breakdown is by looking at the volumes action. But I'm not going to cover that particular concept in this video. Why? Because I've already created an entire video on volume action. In that video, you will learn how a real and fake breakout can be identified using the volumes action. So I'll make sure that towards the end of this video, that particular video should be shown as the recommended ones, and it should also be flashing right now on the corner of the screen. Go ahead and watch that particular video. That will teach you a lot about how to interpret volumes and also how to make sure that we avoid fake breakouts. So this is all that I wanted to cover in this particular video. Let me know if this is something that is going to help you in your trading as well, or if you have any comments or questions. I'll see you soon.